Good afternoon, Pak Chatur and friends. We are from Group 2 and we are going to present about our final assignment. Next slide, please. Our team members consisted of Azahra, me, myself, Nisita, Kezia, and Tubagus. Next. The first part is I'm going to explain about the general information about our business. Our name of business is eClean, shortage for Easy Clean, and an eClean is an online application to book a household needs, more like one-stop home services, as the bridge between customers and services, with high quality and reliable partners. This includes a partnership with nannies, helper agency, gardener services, disinfectant services, vacuum hydro cleaner services, and also car polishing and cleaning services. Next, I'm going to explain about the business canvas model. As for our key partners, we will have investors, ART Foundation, cleaning vendors. And as for our key activities, we are going to be the bridge of communication between vendors and the household. For our key resources, we hire administrative staffs, workers, ART, and vendors. For our values propositions is to help household to find ART. Our customer relationships consist of customer care, social media, and we give out promos and discount regularly, also email newsletters. For our channels, we use social media, Instagram ads, billboard advertising, as well as review or user ratings. For the customer segments, we use applications users, mostly millennials and Gen Z, newlyweds, Gmail member, and busy people. For our cost structures, its fixed cost is the commission fee, vendor for application, and for the revenue streams is for the application's users, commissions from partners or merchants, and in-app advertisement.
Next, we're gonna discuss about the funds needed for our business. Next slide, please. For the purchase of fixed assets, we assume that we need 5 laptops with a total cost of 28 million for our virtual office needs, and 2 printers with a price around 1,740,000 rupiah. With these 2 calculations, the total purchase of fixed asset is around 29 million rupiah. The working capital required comes from purchase for mobile apps for around 1 billion. These mobile apps will later be used for transactions to occur for ordering the services that we provide. We assume the salary for our employees is around 292 million rupiah with a total of 13 times salary, including bonus in a year, with the cost needed to create a virtual office of 6 million. Operating expense also came from marketing and R&D division expense of 90 million, as well as purchases of other office equipment worth 2,380,000 rupiah. With above calculations, we assume that the total operating expense needed are 390 million rupiah, with the total of fund requirement of around 1 billion rupiah, 1,400 million rupiah. For the details of the funding needs, we plan to collect capital from our own capital of 60% with a value of around 800 million, capital from family of 25% with a value of 360 million, loans from friend of 10% with a value of 140 million, and we assume loans from fintech with the smallest proportions of 5% or about 71 million. The cost of funds of each debt is 6% for our own capital, 6% for the family, 10% for friends, and 18% for the fintech, with weighted average cost of capital of 7.6%. Next slide, please. Next, we're gonna explain about the balance sheet of the beginning of the year. Based on the assumptions of the needs for funds, from the previous sheets, we make a balance sheet at the beginning of year 0 with the following calculations. Cash is used as a plug-in variable whose calculation is derived from the total liabilities and equity minus total assets minus total current assets. We assume we have no trade receivables or account receivable because transactions are paid in real time on the application using debit card. And also we do not have any office equipment because inventory comes from partners who work with us. For office supplies, here are the price of the equipment we need. For non-current assets, we assume that we do not own land or buildings because we use a virtual office to minimize existing costs. And as explained in the previous slides, 29 million is needed for the purchase of laptops and printers. Current liabilities come from loans from funds and fintech loans with a total of 213 million rupiah because we assume that these two debts must be repaid immediately. We assume we have no long-term debt. Lastly, we assume equity comes from joint capital and family capital with a total of 1.2 billion rupiah. Next slide, please.
Now we're going to explain about the assumption of cost of revenue. This is the assumption for cost of the revenue. First, we use the assumption time taken to process the order is 30 minutes per order, and time taken to check the payment is also 30 minutes per order. For the hourly wage is 22,500, and for the application maintenance that gonna be used for common overhead cost is 100 million rupiah. The assumption of 0.0625 is taken from 30 minutes divided by 8 hours, which is the working hour for each employee. And this one is also the same. And for the hourly wage, we calculated is the monthly employees gaji divided by 8 hours of working hour and 25 working days. So this is for the DL budget. We use the service produce 15%, 15,000, 5,000, 8,000, 5,000, 3,000, 5,000. And for the DL hours, this is the calculation. And DL cost per hour is 22,000. So we get the total DL cost per unit is 2,813. For the overhead budget, we use the app maintenance and also the amortization for the overhead budget, which then for the total overhead cost per unit is 3,676.83. Thus, the total cost of revenue is 6,489 rupiah for each services. Now we're going to the assumption. This is the assumption. When we take a look at the assumption, we use the growth of the sales is for the year 1 to year 3 is 11.31%, and for the year 4 and year 5 is 17.81%. This amount resulted from the combination of volume growth and also the price growth. So we get this number. And for the year 4 and 5, it is higher because we plan to have another branch in another city. For the assumption of account receivables is 0, and also for inventory is also 0 because we don't have any account receivables because we pay in advance. And for the inventory, we don't have also inventory. For the equipment is 1%. For the account payables is around 29% or 30%. For the fixed asset is 4%. And for each HPP or beban pokok penjualan is 37.08%. We already we calculated in our trial balance. So we get this, and also for the beban operasi, and for depreciation expense tarif penyusutan is 10%, and tingkat suku bunga is also 10%. For the tax payable is 25%, tax tariff, I mean, and for the ratio of the dividend payment is 45%. And the cost increase in the year 1 to 3 is 2.5%, and year 4 and 5 is 5%. Again, it's because we plan to have another branch in another city. And the assumption of our revenue is like this. We use the volume and price per unit, and we have the commission rate, and the volume for successful transaction housemat services, gardener services, disinfectant services, vacuum hydrophilic services, and car policy services are as follows. This is the price for each of the services, and this is the commission rate. Thus, for the assumption of revenue, we will get the sum of this. And this is for the beban pokok penjualan, and this is the calculation where we get the assumption above. And next slide, we're going to talk about the FS projection.
Okay, so next we will be discussing about the financial projection. The first one will be regarding profit and loss statement. So as discussed before, we have concluded that we have a revenue that increased from year 0 to year 5, and then subtracting it with the cost of revenue, we will have the gross margin, and then subtracting it also with operation expense and accumulated and depreciation expense, and as well as interest expense, we will have earning before income tax, and then subtracting it with the tax, we have earning after tax, and then after that we will have a dividend starting from year 1, and then we will have a retained earning as stated in the Excel. And next, about the financial statement position. So in the first year, we have cash and cash equivalent of 1 billion rupiah, which we assume that it will increase until year 5. We have no account receivable as well as inventory, but we do have an equipment which was already explained before, including that includes computer, and that will include computer, printer, and etc. And for the total of asset, which we will have 1.4 billion rupiah in year 0, which we will assume that it will increase until year 5, and as well as the liability and equity. And then next, for free cash flow calculation, here we just input the number that we have calculated before. We will have earning after tax, adding it with depreciation. However, as explained before, we do not have accounts receivable nor inventory, so there we just put 0 in it. And then the increase in equipment are as stated. And next, it will be subtracted with increase in fixed asset, and then we will add it up with interest expense after tax. Then there we will have a result of free cash flow, which is 39 million, and in year one, 48 million in year two, 54 million in year three, 60 million in year four, and 71 million in year five. Next is our cash flow statement. So as we can see here, we again just input the previous calculation that we had. And after that, we concluded that we have cash flow from operating activity of 29 million in year one, and increased as the year goes by. Our assumption is by year five, we will have 70 million. And the same goes to operation cash flow from operation activities and cash flow from financing activities. The thing that needs to be highlighted here is the increase in cash and cash equivalent. In the bold number, we have the summary of operating cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity, while the unbolded one is from the subtraction between cash and cash equivalent from the current year to the previous year. And we conclude that there is no difference there. And next, we have a financial statement ratio. The first one we will is about our liquidity. We have a current ratio of 6.72, which will increase as the year goes by until in year five we have 7.13. And quick ratio test is also calculated and shown in the Excel, and as well as the cash ratio. For activity, we since there is no accounts receivable occurred because it's a real-time transaction, we have no accounts receivable as well as accounts receivable days. And for inventory also, as explained before, there is no inventory needed because the business require no inventory. The total asset turnover is as calculated, which increased as the year goes by, as well as fixed asset turnover. And for solvency, debt to equity ratio, we have 17% in year one, 16.74% in year two, 16.44% in year three, and etc. And for the TIE, we have 2.99 in year one, and the range is from 2.99 to 5.15 from year one to year five. And for profitability ratio, we have calculated gross margin stable from year one to year five, amount at 62.92%, and net profit margin will increase slowly from 4% to 4.85%. And for return of equity, it also increased from 2.56% in year one to 4.93% in year five. And lastly, the sustainable growth, we have a growth from year one is 1.41%, year two is 1.6%, year three is 1.88% to 2.71% in year five. And next, we will be discussing about the payback period.
Next, we're going to discuss about payback period, internal rate of return, and profitability index. Next slide, please. So our calculation are based on from the Excel. Can you go back to the sheets, please? So here are the input sections with assumptions that year zero needs are 360,894,000 rupiah, with the needs of around 54.48% of sales each year, with the purchase of mobile apps around 1 billion. Purchase of equipment for 29 million with a useful life of 5 years, and using the straight line method of depreciation, assuming the selling price of the equipment at the end of the year is 10 million. Purchase of mobile apps for 1 billion with a useful life of 10 years, also using the straight line method for depreciations, and assuming the selling price is 0. The applicable tax rate used is 25% with the required yield of 7.6%. In the computation section, sales are deducted with cost of revenue for around 269 million in year one, and also deducted with the depreciation and amortization for 104 million, which came from the purchase of equipment and mobile apps, so that the total earning before interest and tax in year one is 367 million. And as you can see, the earning before interest and tax is increased from year one until year 5. After that, we deduct the tax rate of 25% and adding back the depreciation. The operating cash flow in the first year is 193 million rupiah, and the same things happen up until year 5. Changes in working capital in year 0 came from the input section, which was 360 million, with the assumption that the cash outflow was the same. In the following year, assuming sales of 768 million, working capital needed is 54% of the total sales, for a total of 435 million rupiah, with cash outflows calculated from net working capital plus cash flow of 44 million rupiah, and also the same thing happened up until year 5. Capital expenditure of 1 billion rupiah comes from the need to buy the mobile apps. The following is the calculations of the cash flow projection obtained from the previous calculation. The operating cash flow after that is deducted by the initial working capital and changes in net working capital obtained from the calculation of changes in working capital above. Based on the calculation of the cash flow projection, we assume that there's a positive increase in projected cash flow every year. The payback period calculation result is 4.52 years, assuming that in the 5th year, there has been the profit in our business, while in the discounted payback period calculation, we get a result of about 4.94 years, assuming that in the same year, there has been a profit in our business. With the above calculations, the NPV we get is around 43 million. Can you scroll down, please? 43 million, because it has shown a positive results, we assume that we can accept this business. The internal rate of return we get is around 8.46%. With this result, we assume to accept the IRR because the nominal is already higher than our weighted average cost of capital. And also because our profitability index indicates more than 1 in the result, we assume that we also can accept this business. That is all from our presentations, and thank you for listening.
Thank you.